The first and arguably most insidious wealth drainer is what we might categorize as the invisible tax. Most people know it simply as inflation, but the real trap is not merely the rising cost of living. It is the psychological illusion of safety that comes with hoarding cash. In the United Kingdom, we are culturally conditioned from a very young age to view high street banks as the ultimate safe haven. We are taught by previous generations that building up a massive balance in a standard savings account, a cash ISA, or accumulating premium bonds is the absolute pinnacle of financial responsibility and prudence. Psychologically, this approach feels incredibly secure and comforting. When you log into your digital banking application on a Tuesday morning, the number displayed on the screen is exactly the same as it was on Monday. There are no red arrows pointing downwards, no sudden market crashes wiping out your hard-earned money, and absolutely no volatility to keep you awake at night. However, Warren Buffett consistently warns that this comforting feeling of safety is a deeply dangerous financial illusion. He points out that while cash feels secure because its nominal value does not change, it is mathematically the worst long-term asset you can possibly hold in your portfolio. To understand why, you have to think about the reality of the British economy and the fundamental nature of fiat currency. We have recently lived through a period of double-digit inflation, a devastating economic force which has permanently rebased the cost of groceries, energy bills, transport, and housing. Even when inflation is finally tamed by the central banks and brought back down to the Bank of England target of 2% per annum, your money is still quietly dying in that savings account, just at a slightly slower pace. Buffett famously described inflation as a gigantic corporate tapeworm. It is a parasite that consumes your purchasing power quietly, from the inside out, without you ever noticing a single drop in your nominal bank balance. The human brain is naturally wired to understand linear concepts and absolute numbers, which is why we struggle to comprehend the silent exponential decay of our purchasing power. Let us contextualize this severe wealth drainer with a detailed thought experiment. Imagine you had £100,000 sitting in a standard high street savings account 20 years ago. On paper, you still have £100,000 today, plus a negligible amount of interest that the bank graciously allowed you to keep. But in terms of real purchasing power, which is what that money can actually buy in the physical world to sustain your lifestyle, you have lost a truly devastating amount of wealth. 20 years ago, £100,000 could buy a decent family home in many parts of the UK outright, without the need for a mortgage. Today, that exact same £100,000 might barely cover a standard 20% deposit on that exact same house. The philosophy of Buffett states that the worst investment you can possibly have is cash, as it is a mathematical certainty that it will become worth less over time. In stark contrast, good businesses are going to become worth more over time because they can adapt. This stark reality does not mean you should hold zero cash to your name. Having a highly liquid emergency fund covering 3 to 6 months of vital living expenses is absolute common sense and a cornerstone of basic financial planning. You undeniably need cash readily available for when the central heating boiler inevitably breaks in the freezing month of December, or when your primary vehicle unexpectedly fails its annual MOT test. But treating a standard savings account as a primary vehicle to build generational wealth is a guaranteed, mathematically proven way to go broke slowly. To preserve your capital and genuinely grow your wealth, you must consistently convert your depreciating fiat currency into highly productive assets. You need ownership shares in profitable, cash-generating businesses that possess the ultimate defensive weapon, which is pricing power. When a business has pricing power, it can seamlessly raise the prices of its goods and services in line with inflation without losing its customer base, thereby protecting your underlying wealth from the invisible tax. The second silent drain on your wealth is almost entirely ignored by most everyday retail investors because it looks so utterly harmless on a piece of paper. This mechanism is the friction of wealth, more commonly known throughout the financial services industry as investment management fees. If you currently hold a workplace pension in the UK, or if you have ever sat down in a polished office with a bespoke wealth manager who strongly recommended an actively managed mutual fund, you are absolutely paying for this friction. The wealth management industry, situated in the City of London, is incredibly clever at presenting these ongoing fees to the public. They deliberately quote them as tiny, seemingly insignificant annual percentages, cheerfully stating they only charge 1.5% a year to actively manage your investment portfolio. To the untrained ear of a normal worker, 1.5% sounds like a phenomenal bargain for professional financial expertise. We are conditioned to believe that price equals quality, a rule that certainly applies when hiring a surgeon or an architect. Therefore, paying a small fee to a financial expert seems logical. But over a lifetime of compounding investments, that tiny percentage transforms into a weapon of mass wealth destruction. Warren Buffett absolutely despises high investment fees because he understands the brutal arithmetic of compounding costs. In his 2005 annual letter to Berkshire Hathaway shareholders, he illustrated this massive problem perfectly with a brilliant parable about a fictional family he called the Gott-Rocks. The Gott-Rocks family owned 100% of all the profitable businesses in the country, and because they owned everything, they were incredibly wealthy, and their wealth grew exactly in line with the economic growth of the nation. But eventually, human nature took over, and they started hiring helpers. These helpers took the form of stockbrokers, wealth managers, and financial consultants, who convinced different members of the family to actively trade shares between themselves to try and outsmart each other. The underlying businesses did not suddenly produce any more money or become more efficient, but a massive chunk of the overall profits was now being siphoned off continuously by the helpers in the form of management fees, transaction costs, and performance commissions. Over the years, the Gott-Rocks family grew steadily poorer, while the highly paid helpers grew incredibly rich, all without producing any actual goods or services. Let us examine the brutal, undeniable mathematics of this financial friction. Imagine you diligently utilize your full £20,000 UK ISA tax-free allowance, investing it carefully over a 30-year period. Let us assume the global stock market returns a historical average of roughly 8% a year. If you use a simple, low-cost passive index fund charging a microscopic fee of 0.1%, your wealth compounds beautifully with almost zero drag. You end up with a robust investment portfolio worth hundreds of thousands of pounds, keeping almost all of the market returns for yourself. But if you give that exact same money to an active fund manager charging 1.5% annually, you are not simply losing 1.5% of your initial capital. You are devastatingly losing the exponential compound interest that 1.5% would have generated over 3 entire decades. By the time you finally reach retirement age, that seemingly tiny annual fee could easily eat up anywhere from 30 to 40% of your total potential wealth. You are effectively handing over a third of your entire life savings to a fund manager sitting in a luxurious office in Mayfair. Furthermore, statistical evidence consistently proves that over a 15 to 20-year investment horizon, the vast majority of these highly paid active managers will actually underperform the very market index. You could have simply bought yourself for mere pennies. The ultimate solution provided by Buffett is relentless in its absolute simplicity. You must ruthlessly keep your investment costs as close to zero as humanly possible. You absolutely do not need to pay a premium fee for a professional to try and guess which individual stocks are going to go up next year, because empirical evidence shows they cannot predict the future any better than a coin flip. The rational approach is to simply buy the whole haystack through a broadly diversified, low-cost global tracker fund or an S&P 500 exchange-traded fund. You hold this low-cost fund strictly inside a tax-free wrapper like an ISA or a self-invested personal pension, and you allow the magnificent mathematical force of compounding to do the heavy lifting for you, completely cutting out the expensive helpers. The third hidden wealth drainer is arguably the most destructive force in the realm of personal finance, and it is entirely rampant in modern consumer society. We will categorize this specific wealth destroyer as the reverse snowball. If you have studied the investment methods and public speeches of Buffett for any length of time, you will know he deeply reveres the concept of compound interest. He views it as a magical snowball rolling down a long, snow-covered hill, continuously gathering mass and momentum, getting significantly bigger and moving far faster as time goes on. But the crucial reality about compound interest is that it is an entirely neutral mathematical phenomenon. It has absolutely no morals, no empathy, and no conscience. It does not care if it is working for you to build generational wealth, or if it is working ruthlessly against you to keep you impoverished. And when compound interest works against you, it overwhelmingly takes the form of high-interest consumer debt. Here in the United Kingdom, we are currently living through a completely normalized epidemic of high-interest borrowing. Driven by aggressive marketing and social media pressure, it has never been easier to seamlessly finance a lifestyle that vastly outstrips our actual monthly income. We have buy now, pay later schemes seamlessly integrated into almost every single online retail checkout page, encouraging us to split payments for basic clothing and electronics. We have millions of hardworking people carrying rolling balances on credit cards at 25% annual percentage rates simply to fund annual summer holidays and rapidly depreciating consumer goods. And quite uniquely to the British economy, we have the massive personal contract purchase car finance bubble, where individuals happily pay hundreds of pounds every single month for the supposed privilege of driving a shiny new luxury vehicle that they will never actually own at the end of the term. The specific advice regarding consumer debt from Buffett is brutally straightforward and leaves absolutely no room for misinterpretation. He views voluntarily paying high consumer interest as a fundamental violation of his famous first rule of investing, which simply states that you must never lose money. He once publicly recounted a very telling story of a close friend who asked him for specific financial advice. She mentioned she had accumulated a modest amount of cash to invest in the stock market, but she also casually admitted she was concurrently carrying a credit card balance that charged 18% interest. The immediate response from Buffett was entirely uncompromising. He explicitly told her that he himself did not know how to reliably make an 18% return in any financial market. He declared that if he ever owed any money at 18%, the very first thing he would do with any spare money he acquired would be to pay off that debt immediately, as eliminating that negative compounding force would be way better than any brilliant investment idea he possessed. It is vital to stop and think about the profound gravity of that statement. Warren Buffett, widely considered the greatest capital allocator of our century, a man who methodically built a $500 billion corporate empire, openly admits to the public that he absolutely cannot guarantee an 18% return in the stock market. Yet, millions of everyday retail investors genuinely believe they can carry a rolling credit card balance at 22% interest, whilst simultaneously attempting to build long-term wealth in a basic savings account yielding 4%. or a volatile stock portfolio generating an average of 8%. It is an absolute mathematical impossibility to win that specific financial game. You are foolishly attempting to swim forward in the ocean while a heavy iron weight is violently dragging you down to the bottom. Before you attempt to pick the next winning technology stock, before you even glance at highly speculative cryptocurrency markets, or consider investing in residential property, you must brutally and methodically execute your high-interest consumer debt. Paying off a 20% credit card balance is the exact financial equivalent of finding a guaranteed, completely risk-free, and entirely tax-free 20% return on your money. No hedge fund manager on earth can offer you those specific terms. You must take that guaranteed return immediately. You need to entirely stop financing a lifestyle you have not genuinely earned yet. Immediately destroy the plastic credit cards and forcefully turn the mathematical snowball around so it finally rolls in your favor. The fourth and final hidden wealth drainer is entirely psychological in nature, yet it systemically destroys the investment portfolios of retail investors every single trading day. We can accurately call this wealth-destroying behavior the activity illusion. In our hyper-connected, heavily digitalized modern world, we are culturally and biologically conditioned to believe that physical or mental action directly equals positive results. This makes logical sense in almost every other aspect of human life. If you want to get physically fit, you go to the gymnasium and lift heavy weights until you sweat. If you want to secure a promotion at your workplace, you arrive early, put in extra hours, and actively volunteer for difficult projects. Because of this deeply ingrained evolutionary conditioning, we naturally assume that to be a highly successful financial investor, we need to be actively doing things all the time. We falsely think we constantly need to be reacting to economic news, tweaking our portfolio allocations, rapidly buying new assets, and panic selling our current holdings. The modern financial technology industry has brilliantly weaponized this inherent human instinct for their own immense profit. We now have sophisticated applications on our smartphones that completely gamify the serious business of the stock market. You can impulsively buy and sell complex options contracts, fractional shares of global corporations, and volatile cryptocurrencies with a simple swipe of a thumb while sitting on the London Underground during your morning commute. Because it is so incredibly frictionless and easy to execute a trade, our brains are flooded with dopamine, and we feel an overwhelming psychological pressure that we should be actively trading to maximize our returns. We receive a sudden push notification stating that the Bank of England has unexpectedly raised base interest rates, so we immediately panic sell our housing and construction stocks. We hear a friend at the local pub loudly bragging about a speculative technology stock that doubled overnight, so we suffer from severe fear of missing out and blindly buy into the asset at the absolute top of the market cycle. We constantly tinker, adjust, and meddle with our life savings. Buffett correctly sees this constant manic financial activity as absolute financial suicide. He frequently quotes his intellectual mentor, the legendary investor Benjamin Graham, who created the famous and enduring allegory of Mr. Market. Mr. Market is a manic, depressive, highly emotional business partner who knocks on your front door every single day, aggressively offering to buy your shares from you or sell you his shares. Most days, the prices he wildly shouts out are completely ridiculous and heavily detached from underlying reality. The absolute key to building generational wealth is to completely ignore the extreme daily mood swings of Mr. Market and to firmly refuse to dance with him. Every single time you aggressively buy and sell assets out of raw emotion, extreme boredom, or sudden panic, you violently interrupt the delicate mathematical magic of long-term compounding. Furthermore, Even if your modern trading application loudly claims to be entirely commission-free, you are still actively paying significant hidden costs through the invisible bid-ask spread every single time you tap your screen. In the specific context of the United Kingdom, you might be constantly triggering stamp duty reserve tax at a rate of 0.5% every single time you purchase a UK-listed corporate share. Moreover, by constantly churning your investment portfolio, you are repeatedly and unnecessarily triggering capital gains tax events, which is absolutely devastating for wealth creation, especially now that the annual tax-free capital gains allowances in the UK have been so drastically slashed by the government. Most importantly, by arrogantly jumping in and out of the financial markets, trying to perfectly time the absolute bottom and the absolute top, you severely risk missing the very few, highly concentrated trading days where the biggest historic market gains actually occur. Statistical studies repeatedly show that if you miss just the top 10 positive trading days in an entire decade because you were sitting in cash waiting for a better opportunity, your overall investment returns are completely decimated, and you will severely underperform a passive buy and hold investor. Buffett and his late, highly revered business partner, Charlie Munger, championed a deeply contrarian investment philosophy of lethargy bordering on absolute sloth. They forcefully argued that a rational retail investor should act as if they have a physical punch card with only 20 available slots for their entire lifetime. Every single time you make a firm investment decision and execute a trade, you permanently punch a hole in that card. If you knew you only had 20 allowed trades for your entire life, you would think incredibly deeply before executing even one of them. You would aggressively research the underlying business, and once you bought it, you would fiercely hold on to it forever. You absolutely do not need to nervously check your retirement portfolio 3 times a day on your mobile phone. You completely do not need to rapidly react to every single geopolitical headline loudly broadcasted in the Financial Times or on the evening news. If you genuinely want to permanently stop this final psychological wealth drainer, the true solution is incredibly boring but highly effective. You must ruthlessly automate your personal finances to remove all human emotion from the equation. Set up a recurring direct debit to automatically fund your tax-advantaged ISA the very day after your monthly salary clears into your bank account. Have that system automatically purchase a broadly diversified, low-cost global equity index fund without requiring any manual input from you. And then, and this is the absolute most crucial part of the entire wealth-building strategy, completely delete the investing application from your mobile phone home screen and go live your actual life. True generational wealth is not built by frantically attempting to outsmart the global market every Tuesday afternoon. It is methodically built by slowly acquiring high-quality, productive assets and having the immense, unshakable psychological discipline to do absolutely nothing but wait patiently for the next 3 decades.